Good afternoon, ladies and gentlemen, and welcome to the Time Finance PLC Annual Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we'll notify you when these are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, we would be most grateful. And I'd now like to hand over to James Roberts, CFO, and Ed Rimmer, CEO from Time Finance. Good morning to you. Good afternoon to you both.
Good afternoon. Good afternoon, everybody. Yes, by way of introduction, I'm Ed Rimmer, Chief Executive for Time Finance. I joined the business originally in June 2017. 3 years I did as Chief Operating Officer, and then rejoined the business at the start of March this year as CEO. I would say that we did a full strategic presentation update very recently in June. So once we've done our introductions, I will fly through some familiarization slides on who the business is and what we do, but we'll try and focus more on the financial results and probably more importantly, where we're up to with our strategic plan. So I'll just hand over to James to introduce himself.
Thanks, Ed. Yes, good afternoon, everybody. James Roberts, CFO of Time Finance. I've been with the group now since May 2017. Prior to that, I'm a chartered accountant with PwC and worked in various buy and build and AIM-listed businesses. But I'm sure, as Ed said, we've heard that before, so we'll hand back to Ed and rattle on through.
Okay, thanks, James. We're going to turn our cameras off now. It's easy just to see the screen without the cameras on. So forgive me if you can no longer see us. Okay, great. Right. So who are we and what do we do? Well, in simple terms, we're an AIM-listed business that provides finance to small and medium-sized enterprises in the UK. We're not a bank. So we don't take retail deposits. We borrow our money effectively on wholesale facilities, which means we operate in the tier 2 sector of the market, and we lend that out to small businesses, predominantly on our own book, but we also have the ability to broker out business that doesn't meet our credit criteria. Generally, if it's tier 1, better quality business with lower rates, or in tier 3 where it's not quite the same quality that we want for higher rates, and we take a commission for that. We have a multi-product offering, which we believe differentiates us from the majority of our competition, where we offer asset finance as well as invoice, loan and vehicle finance. And the business has been trading for around 20 years, previously known as 1PM, and the business rebranded at the end of last year to Time Finance. We have 4 trading divisions, as I just said. I won't go through all the detail here. In summary, our vehicle finance business brokes out all its activities. The other 3 divisions, asset, invoice and loans, predominantly lend on own balance sheet. We generally operate in the tier 2 space. We generally receive introductions through intermediaries, whether that be specialist brokers, insolvency practitioners or consultants, professional firms. We cover soft and hard asset in the asset finance business, factoring and invoice discounting in the invoice finance business, unsecured and secured loans in the loan finance business. And as I say, we broker all our vehicle finance businesses out generally to tier 1 and tier 2 funders. And our funding for own book lending tends to come from a series of wholesale facilities, tend to be challenger banks or high street banks who provide us with our cash. Some numbers: we lend facilities to around 20,000 SMEs. Last year, we originated around £100 million in new business, either on our own balance sheet or broked out. Our balance sheet currently stands at around 57 million, and we achieved profit before tax and exceptionals last year of just over 3 million, which was a slight improvement in the previous year. And in terms of where we sit in the markets, our competitors do include banks, challenger banks, also alternative finance platforms, fintech businesses as they're commonly referred to nowadays, other quoted companies similar to ourselves, and smaller private businesses. Those smaller private businesses tend to compete more with us in terms of the personal service angle, and the speed and flexibility of doing business, but they don't tend to have the product range that we have. The banks, on the other hand, tend to have that product range, but they don't tend to be fast and flexible and provide that personal approach. So whilst we're not completely unique in terms of being the only company out there that does what we do believe that we're one of a smaller number of businesses that has the ability to be fast, flexible, provide a personal service, and importantly have a range of products that we've got that can cover more or less all the requirements in terms of commercial lending that a small business requires at the moment. So that's a flavour of the business. I'll now hand over to James, who will take you through our recent financial results.
Thanks, Ed. Yes, appreciate it. So I'm just going to spend sort of 5 or 10 minutes running through the year's results to 31st of May 2021. As Ed said, we did a reasonably in-depth trading update back in mid-June, and the numbers are very much in line with that. So, but I'm going to try and delve into a little bit more detail in some of the key areas that we think are particularly important for somebody looking at the business. So just a quick whistle stop of the high level numbers before diving in. We can see revenue was down by about 17%, and I'll come on to revenue and why that is in a sec. Profit before tax and exceptionals, as Ed mentioned, was just over 3 million, which is a marginal improvement of 3% on the year before. Earnings per share, 1.98 pence per share, up about 13%, and our net assets on the balance sheet are now just topping 57 million, which is an increase of about 3%. We do have a fair amount of intangible assets and goodwill on the balance sheet. So another key indicator for us is our net tangible assets, which have risen to just shy of 28.5 million, which is about 7% up on the year before. Quite a key thing for us during the pandemic, which I will probably labour the point in a bit on a separate slide, is about cash equivalents, and what we call convertible paper that we can turn into cash within 24 or 48 hours. And that's key for us in ensuring the robustness of the business and providing cash for future growth. And we can see that's increased significantly since the end of May 2020, up at 11.3 million from 1.4 million as at the 31st of May 2021. Our unearned income, and that's interest on leases and loans that we have on our balance sheet at the year end, that assuming they all work to plan, will come through over the next 12, 24, 36 months, depending on the life of the lease or the loan, stands at just under 15 million, marginally down on the year before. And our blended cost of borrowings, which is the cost of funds we get in that we can then lend on to others, is stayed static despite the pandemic at about 4%. Our net write-offs have marginally increased to 1.6%, but pleasingly, we think the book's in a stronger position than it was a year ago. Our deals in forbearance, this is given the pandemic where people came to us and asked for help, has fallen by nearly 100%, 97% reduction from just over 24 million to just under 1 million. And our deals in arrears as a percentage of the gross book have fallen by about a third, from just under 21% to just over 14%. And we've maintained our bad debt provision at around just over £5 million. And I'll talk about most of those key indicators in a sec, but in a snapshot, that's where we sit at the 31st of May. So if we look at a bit at the P&L, I touched on the fact revenue had fallen, and that's due primarily to two reasons. One is our brokerage businesses, and they were particularly hit by the pandemic. They did make up at the year before last about 20% of our revenue, but they've accounted for about 50% of the reduction between FY20 and FY21. So they were particularly hit by the pandemic, and largely that's in relation to the vehicles brokerages, which for a number of the lockdowns were physically closed, the dealers were, and so people weren't able to actually buy cars. So that's part of the driver there. The other half is because of the size of the book. Our net lending book, the average book we had over the last 12 months was just over 100 million compared to about 120 million the year before. And in terms of generating revenue, it's a bit like turning an oil tanker. It takes time. You've got to build up that own book lending piece. That in turn will then provide revenue for the next 2, 3, maybe even 4 years. So the fact that the loan book fell due to the pandemic, we're now in the stage of trying to increase that book again. Revenue will come back, but it does take a little bit of time. As we touched on, we've got about 15 million of unearned income as we start this year, going into this year. Pre-pandemic, we had about 17.5 million of unearned income. So you can see there's about 2.5 million of revenue is just from the unearned income associated with the book. Having said all of that, on the revenue, profit before tax and exceptionals has marginally increased, basically remained static, and profit before tax on the full P&L has stayed at 2 million. So both of those metrics have stayed where they were, given the reduced revenue shows the margins have increased, which is pleasing. And that's due both to a focus on gross profit with slightly lower funding costs, introduced commissions and bad debt charges, and tight operational cost controls, primarily staff costs, which have seen our gross profit margins increase by about 7%, and our profit before tax and exceptional margin up about 3%. Of particular note, in the last financial year, the one we're looking at now is the balance sheet due to the pandemic, and it's one we're quite proud of. We think the pandemic showed the strength and resilience of the group, and that we're able to withstand some pretty tough times. And as you can see, 4 key areas here, just to go over. Net tangible assets, as I touched on, have gone up, increasing to about 28.4 million, and that's because we did remain profitable throughout the period. Given everything that's going on, that was particularly pleasing. Cash is up in terms of actual cold hard cash. It's increased from 0.1 to about 7.7 million. But you may remember on the slide before I mentioned 11.3 million of cash or cash equivalents and convertible paper. And the reason I highlighted that 11.3 rather than just the 7.7 is because at 31st of May, we did have just over 4 million of convertible paper deals that we funded ourselves, but haven't used our funding partners to provide funding to. If we wanted to, we could convert them with our funding facilities within 24, 48, certainly 72 hours into cash at between 80 and 90%. So theoretically, that could give us 3.5 million of cash within 24, 48 hours, hence the 11.3 million. That's really what we've got to play with, for want of a better expression. So really a vast improvement in cash, which was the right thing to do. We think during the pandemic, we tightened our belts, got the business shipshape while everything was going on, and it does give us a strong base to grow from as we move forward. In terms of the existing book, the next 2 columns focus on that. As we touched on, arrears have fallen. They increased greatly to May 2020, largely due to the pandemic. But over the last 12 months, sterling effort from our colleagues in risk and credit have seen arrears reduce by over 1 million from the level they were before. So they are, at the moment, arrears are in a better, lower than pre-pandemic levels, which we think is pretty good. And deals in forbearance, as I touched on, this is people coming to us during the pandemic and saying, for whatever reason, I really can't pay due to the pandemic. Can you help me out? We would, where possible, if it was a valid reason, try and work with our clients. And at one stage, we had about £25 million. That was at June 2020 last year. We're in one form or another of forbearance. It was less than £1 million at year end and continues to fall. So forbearance is, to all greater purposes, pretty much a thing of the past, which we're, again, very pleased with. One thing we have focused on, and I've mentioned many times on these presentations, but I think it has stood us in good stead throughout these times, is the diversification of our lending. And this slide here is just to hopefully highlight that point, that at 31st of May, we had no one sector in our book accounting for more than 5% of the lending. And by the 10th sector, you're just over 1%. So the top 10 sectors of our book are less than 25% of the entire lending. And as you can imagine, that tail goes on and on and on through the multiple sectors that are out there. But that spread has been particularly vital for us and is something that underpins our business model, because if one sector particularly struggles, so for example, in the pandemic, as we all know, hospitality was shut for a significant part of the time, we're not weighted unduly in one particular area such as that. So we are able to ride through the more tricky times because of this diversification. So as we see there, we feel we're a very well diversified business, multi-product offering, as Ed said, across a number of sectors. And that does enable us to withstand a number of headwinds that we've faced. We can only do what we do because of the support of our funding partners, and all our funding partners, I'm pleased to say, have been incredibly supportive throughout this time. We kept our doors open to lend to valid UK businesses, and they kept their support funding lines to us in place as well to help us to do that, and that's great. As we can see here, we have at 31st of May just over 160 million of active facilities that we could use. We'd used about 67 million of it, leaving about 96 million of headroom to grow into. It's worth stressing that we have to put our own funds into every deal. So we put in between 10 and 20% of cash into every deal. But assuming we can do that and our medium-term plans imply we can, then we have a 95 million headroom of which to use up to grow this business over the coming months and years. One pleasing development that's happened in the last week was that our NatWest facility for our Invoice Finance businesses, the 42 million facility you can see there, we renewed for another 3 years. And actually, it includes an 8 million accordion. So if we need it, we can increase that facility to 50 million to enable future growth in the business. But as you can see there, 3 distinct funding lines for our 3 own book lending businesses. Number of partners in each of those, again, diversifying our funding line, particularly in the asset bit. And they've all been very supportive, and it puts us in a strong position, we think, as and when we emerge from all the pandemic effects. And with that, that is a whistle-stop tour of the numbers. I'm sure there'll be questions at the end, but I'll now hand back to Ed, who can take you through where we're going in the future and what we've done over the last few months. Ed.
Thanks. Thanks, James. As James said, what the pandemic has allowed the business to do is really focus on getting it ready for a recovery that we are now seeing taking place. It's early days, and we hope it will start to gather pace through the course of the next few months. But we are starting to see a difference in the market in terms of pipelines building. And obviously for that, what we've done is use the opportunity to get ready to take on those opportunities. And part of that, this is on the screen is an extract from our report and accounts. And part of that is obviously my appointment into the business, coming up with a new strategy, and obviously now looking to deliver it. And that's effectively what we've done over the last few months since I returned to the business. And the summary of that really is fourfold. We want to use the rebranding of the old 1PM business and its associated brands to become a recognised national funder under the Time Finance banner. Through that, we would like to double our lending book up to around 250 million, achieving profits as stage 1 back up to where we were pre-pandemic as soon as possible, and then push on above where we were pre the pandemic, and obviously with that significantly strengthen our balance sheet as we focus more on own book lending, so that through this period, which is a 4-year strategy, it takes our tangible net assets up to around 55 million. How are we going to do that? I introduced this slide in the presentation that we did in June, so it's a complete repeat of that. So if you've heard it before, forgive me, but the next few slides will give a progress update on some of the key things that have happened. So I'll just summarize how we're looking to do this. It's really 6 key strands of activity. The first is focusing on our core products, the asset, loan and invoice finance businesses that are all on our own balance sheet. We do have some what I would call non-core business in the group, which is business to consumer lending, which is all brokered activities. And we're not looking to necessarily focus and grow those businesses. It's the own book side of the business that we're looking to focus on through those core products. The multi-product offering, as I mentioned, really does differentiate us from a lot of our competitors, and moving into offering an integrated asset-based lending proposition is something that is key to us moving forward. I've mentioned about repositioning the brand and putting some investment into marketing so that we do that both through traditional channels and through digital capabilities, which I'll mention in the next couple of slides. We recognised that we needed to invest in some further talent, predominantly some sales origination talent, which is in progress, and we've made some real positive progress with that, which I'll come on to. Another focus is bringing further liquidity into the business, something that James is tasked with obviously doing. Our liquidity position is better than it, materially better than it has been at the height of the pandemic, when we had quite a bit of the book in forbearance. And we're now looking to use that better liquidity to grow, particularly the asset finance and the loan business, which needs equity to do that in order to tap into our debt facilities. And we'll continue to do that as we deliver this growth plan in terms of bringing additional liquidity into the business, and also to look at targeted acquisitions. That has not gathered an awful lot of pace as yet because there's been other priorities, but as and when they come up, then we would like to look at additional acquisition opportunities that fit with our core product offerings. So in terms of some progress against those strategic initiatives, the first one, focusing on our core products. We were approved as a lender under the CBILS scheme, and we used our allocation to lend around £12 million under that scheme. Pleasingly, we were able to get accreditation under the recovery loan scheme as well, which was launched a few months ago, and that is gathering pace in terms of the volumes that we're seeing across the business. So that's a positive that we've experienced over the last 2 to 3 months. We've also restructured our asset finance senior management team to provide us with some operational expertise and move forward some of our systems initiatives that we really need to move on with in order that we can keep pace with the market, but also offer a better user experience to our customers. We are also looking for a new head of asset finance to replace our long-standing head at the moment, Carol Roberts, who is due to retire. And that should be an exciting announcement in the next month or so. We're down to a short list of candidates to take our division forward in the asset finance world. And we've repositioned our soft asset proposition, which I mentioned the last presentation. We were seeing lots and lots of small deals, which were creating quite a lot of unnecessary work and quite a bit of inefficiency. So we've now repropositioned that so that we have a minimum ticket size of £5,000. And that is meaning already that we're seeing a slightly higher average ticket size coming through, and as importantly, a more manageable flow of inquiries where we can convert at a better level. So progress and good progress being made there with our core product offerings. In terms of the multi-product solutions, we've recruited a new director of the loans business and also ABL to take this forward. Lady called Sharon Bryden, who is very experienced in the sector and has worked with me before. She joined at the beginning of September, settled in very well, and has a long list of things to be getting on with over the next few weeks and months. And key to that is developing the ABL proposition, which Sharon will be responsible for. We've also relaunched our cross-sell initiative, which is badged as Excel. That was formally relaunched at the start of September. We've developed an internal portal to manage the process flow across the business. And we've got some specific targets for each of the products. And we're already seeing some exciting cross-sell opportunities coming through the pipelines through our various teams. James mentioned earlier, in terms of the bringing further liquidity into the business, it's not necessarily further liquidity, but it is an important development. Our back-to-back provider, NatWest, for the Invoice Finance division has reconfirmed the terms, put a new facility in place over the next 3 years. It's got improved terms as well, so it's slightly more cost competitive, and we have got the additional 8 million accordion, and that will see us through for the next couple of years at least. So that's a real positive from our funding side of things. Investing in further talent, that's taken up an awful lot of time. I've spent quite a lot of time on this because of contacts that I've had in the industry over the years, and we've made some good strides. Obviously, I was appointed as CEO permanently from the 1st of June. And that's enabled, I think, other people to see the certainty that we've got now around the plan, and it's helped attract other people into the business. We've increased our sales resource in the Invoice Finance business, including a new head of sales, a chap called Adrian Payne, who's joined at the start of September. Very seasoned professional in that world, and will attract other resource, I'm sure, into the business. And we've also brought in 3 additional business development managers. Our plan is to get up to 12 people within the sales side on Invoice Finance. We started off at the beginning of our financial year with 6, and we've now got 9 in place. So good progress made there, with a reasonable number of discussions continuing to take place as well. And we've also increased the size of the sales force in the asset finance team by taking on 4 additional new business people. And we've also put a lot of work into the rebranding and the capitalisation efforts of the rebrand that was done at the end of last year. Our head of marketing, Diane Blinkhorn, very experienced. She worked with me at Bibby for 13 years. And we have Kate Brown also heading up the marketing function, who is doing a sterling job at taking our PR effort into the market and raising our profile. We've definitely seen that improve in the last 3 months, not just in terms of what we see ourselves, but the comments that we receive from our introducer network in terms of the deals that they're seeing being done as case studies, and the people that are joining, and other stories that we're looking to get out into the press. So that whole repositioning of our Time Finance brand is gaining good momentum. And we've also recruited a digital marketing executive to take on that side of the business with a bit more gusto. So overall, I would say good progress being made. In terms of the summary and our outlook, going back to James's comment, I think the business has shown a lot of resilience through the pandemic, and the liquidity has certainly improved, putting us in a better position than where we were at the start of this calendar year. We've strengthened the management team. We've got a new vision and a new strategy now to deliver a 4-year plan that's already started, and we've made good progress with that. The business does stand out with our multi-product offering. That's a common theme that we hear from new people that are attracted to the business, our clients, and also our introducer network, and we're looking to take full advantage of that. And I think what we've done really is try to put the business in our best possible shape, to take advantage of the opportunities that come up post-COVID, and make sure that we are well positioned to do so. And I'm very happy with the progress we've made in terms of the strategic plan. I would like, obviously, to see the market come back now, and hope that the momentum that we've seen over the first part of September continues through the autumn. And if we can see that, then I think the business will do very well. That's the slides complete. So thank you for listening.
That's great. Ed, James, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Ed and James take a few moments to review investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation's ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. James, Ed, obviously investors had the ability to pre-submit questions along with a number of questions that have been submitted during the live event. And perhaps, James, I could just hand back to you, and where appropriate, if I could ask you to read out the question, who it's from, and to give a response. And of course, if you guys want to bring on your cameras, please feel free to do so just by simply clicking on that camera icon at the top.
Thanks, Mark. Yes. So yes, there were 3 pre-submitted questions. I think 2 of them are very, very similar in what they're asking. So I will answer one of them, and hopefully that ticks off the second one, and then I'll hand on to Ed for the third, and then we'll go through all the new questions that have come up today. But one of them was, as I say, which is very similar to the second one as well. Can you please discuss your thoughts on capital allocation, in particular at what ROIC threshold you prefer to pay out capital through buybacks or dividends instead of retaining it? I suppose in a nutshell, in a simplistic answer to that question is, at the moment, as explained in the medium-term strategy, our aim is to reinvest all our funds for the short-term, medium-term into growing the business. We want to get back to and beyond where we were in 2019 before COVID hit, and that does mean lending more on our own balance sheet and using our cash to lend on our own balance sheet to grow as safely and securely, but as quickly as we can. As such, there's no real specific ROIC hurdle currently in place, but once we get to the size we were at and beyond, or if we find the demand is not there, then we will reassess and look at the best use of our capital, whether it's to reinvest for growth, to pay dividends, or repurchase shares. So apologies, there's no sort of scientific figure to tell you about, but it is at the moment very much all focused in growing that own book lending book, which in turn will strengthen the balance sheet and hopefully lead to enhanced shareholder returns in time. That's where we stand on that. The second question, as I said, is very, very similar. So I hope I answered that. And Ed, are you okay to take the other one, which was, how do you expect the size of the own book portfolio to evolve in the next 3 to 5 years?
Sure. Yeah. I think we covered that, didn't we, in terms of the presentation? So it's really taking the book at the moment, which stands at around 110 million up to 250 million over the course of the 4-year plan, and that's how we see the growth being met over that time scale. As I've said, predominantly through focusing on the own book side of things and the core products. So I'll be repeating myself if I go on any further, but yeah, that's what we're looking to do.
The next question is from Martin T. Thank you, Martin T. It says, can you please comment on the increase in net write-offs? Did Time Finance change the lending requirements? I'll take that one, Ed, if that's okay. In terms of the net write-offs, as I mentioned, they increased from FY20's levels of about 1.3% to about 1.6% in FY21. I'd probably say it's not a material increase, but it's not to be. We didn't find that unexpected, despite what we think is pretty robust underwriting and collections process, and despite the support that was out there from the government through CBILS, bounce back loans, etc., etc. Inevitably, with the effects of the pandemic that there would have been and were on the economy, not every business would have made it through. And so that really is what happened. As I touched on earlier, hospitality was particularly hit, as we know, with restaurants and bars and coffee shops, etc., closing. And not all of them reopened. And so inevitably, we did incur slightly higher write-offs than before. I think the pleasing thing from our point of view is that they went up. It wasn't a material increase, which a number of people feared back in, say, March, April, May 2020, when this first arose. And as I say, we are now in a much stronger position moving forward. So that, in a nutshell, that's pretty much it. Unfortunately, not every business could survive. So write-offs did increase. There was no change really in the lending requirements. If anything, we've tightened our credit criteria and our lending requirements during the pandemic, but we certainly didn't open the doors to new types of business that we weren't experienced in. It was just the nature of the beast due to the pandemic. The next question I'll read out, Ed, but I'll hand to you if that's okay. Simon C says, "Are there any plans to increase the range of products you offer to SMEs?" I appreciate it's fairly comprehensive already. Ed.
Yeah, it is fairly comprehensive for what we think is the first part of our organic plan. So there's absolutely nothing at this moment in time that we're looking to launch imminently. But I would say that there's some adjacent products to what we already do that I'd like to look into pursuing and offering. So, for example, trade finance, where we fund imports against confirmed orders. It sits quite nicely with Invoice Finance. It's a very specific offering. You need people that have got experience in that world, and that's something that we could look at, and I'd like to look at. Also, some bridging loans as well that I think appeals, and it sits quite nicely with what we already do in terms of the commercial loan space. There's some good margins that we can make on that, and I think as the recovery starts to gather pace, there'll be opportunities in that world as well that we can do on our own balance sheet and brokes out. So there's a couple of examples there of products that are in my mind that we can offer that are adjacent to what we already do, but it's unlikely that we will launch anything completely new that isn't in line with small business lending, and we do have reasonable coverage of across those products already. So hopefully that answers the question.
Thanks, Ed. Peter D asks, "Does the NatWest facility mean that there is no need for an equity raise unless there is an acquisition opportunity?" Ed, would you like to take that, or do you want me to?
Yeah, no, I'm happy to answer that, James, and chip in if I miss anything. Just to clarify, the NatWest facility is really the same as we've got with the block funding facilities for the asset finance, in the sense that it's available to us to draw down against funded business. What you can't do is just borrow that money and use it for whatever you want. You can only use it for the products that we're providing. So if we take on more business, we have more than sufficient funding to draw down on in the Invoice Finance world through that NatWest facility, but it doesn't allow us to just use the capacity in that facility without providing client facilities to draw against it. I hope that makes sense.
Thanks. Okay, we got another question from Martin T. Following up on the capital allocation question, can you please elaborate on the strategic rationale behind not considering buybacks at any price, i.e. any undervaluation level? Again, Ed, do you want me to take that, or do you want that? I'm happy for you to take that, James. It's a more finance related question. Thanks. Yeah, I suppose it's not to say we won't ever do any buybacks, but at the moment we feel we are and have been undervalued for quite some time, and buying shares back, which we have done in the past, hasn't really impacted anything as such. The decision of the board was that we feel we can get the best increase in shareholder value by growing the balance sheet. That's where we think the real enhanced value will come. Obviously, that's not to say never. If the share price reached some crazy point, you never know. But there's no cut-off in our minds at the moment. We'll address it as and when it happens that we would begin a buyback. Apologies if that's a bit vague, but it is very much use the capital that we have to grow this business to as large as we can, over the short to medium time. And that's really what we're going to do. Obviously, if there's a huge unexpected change one way or the other, then we will reassess that, and we do every month, every quarter. We have a look at where we are and what we're doing, but at the moment, it is focused purely on growing that balance sheet. We've then got a question from Colin C. There have been large sales hirings. When do you expect these to show an upside in the figures, and why no published targets for each year up to the doubling of the book so that the progress can be measured? Ed, would you be all right to answer the first part on the sales hirings? Can I just quickly answer the point on the published targets?
Sure.
Just for people out there, we do have a house broker, and we are followed by a couple of other analysts, and they have published forecasts for the next 2 or 3 years, and they are out there. So there are numbers out there by various analysts. So I just wanted to clarify that. Ed, are you able to take the point on the hirings and when the upsides might be seen?
Yep, certainly. Well, like everyone, we want to see the upsides as soon as possible. That's the simple answer. The practical reality is that people do take a bit of time to bed in. But I would say after 3 months, we should start to see some impact on the numbers. Typically, it could be a little bit shorter. It could be a little bit longer. It obviously depends on the market conditions as well. But let's assume that they're starting to come back and they stay that way between now and Christmas. I would hope that impact of the investment on new business is starting to show through by then.
Ed, James, I might just there's a final question that's just popped in, so I'll just let you review that in case that's
Sorry. Yes, and Martin T again. What is the target return on capital you aim to achieve with the new mid-term strategy? In 2018, the ratio was around 15%, and it is currently in the low single digits. Eddie, are you happy if I talk about that? Or
Yeah.
Again, I suppose this links into the forecasts, which, as I touched on, are out there under the brokers that have published. And if you look at those, you can see that, as we've alluded to, that we are aiming to get back to and beyond pre-COVID levels. Once we are at that point, we will see return on net assets, net tangible assets, etc., back up to similar mid to high teens as they were before.
James, Ed, thank you very much. And obviously, thank you to all those investors that have taken time to submit questions today. But you've been very generous. Every question that's been submitted, you have responded to. So thank you both to you. I know investor feedback is important, and I'll shortly redirect investors to provide you with their thoughts and expectations. But before doing so, Ed, perhaps I could just hand back to you just for a few closing comments. And then, as I say, I'll redirect investors to give you their feedback.
Yeah, thank you. Well, yeah, I mean, as I said, really in the summary, I think the pandemic has taken its toll on many businesses, and we're no exception. We have used that time to deliver what we believe now to be a sensible plan to move forward, and we're pretty much, I would say, well progressed now in making sure that it's set up the business to deliver on that plan. And we've started to do so. So I think, as I said in the report and accounts in my section, I would look forward with a sense of optimism, particularly if we see the pipelines that we've seen over the last few weeks continue to build, and business confidence start to build over a more sustained period. And I would say that's really between now and Christmas. So I think the business is well set up to deliver its plan. And deliver success over the period that we've set out, which is our 4-year plan.
Ed, James, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Time Finance PLC, we'd like to thank you very much for attending today's presentation. That now concludes today's session. Good afternoon to you all.